Over to you, Fredrik.
Thank you, Ole Christian, and welcome everyone. My name is Fredrik Bjelland. I'm one of the portfolio managers on SKAGEN Kon-Tikis. Very thankful that so many of you are taking time out of these volatile markets and busy times to listen to an update on how we see the market and also how the fund is positioned. Clearly, we've got a challenging backdrop at the moment. I think the first quarter, which just finished yesterday, was one of the weakest equity markets on record. I think it's also worth bearing in mind that these kind of volatile times, no doubt, will also create opportunities for long-term investors such as yourselves, and that we also try to adhere to at SKAGEN throughout all of our equity funds. Also, rest assured that for SKAGEN Kon-Tikis, we've got a team of the four of us. Many of us have been through challenging markets in the past, most recently in the financial crisis of 2008, but also more recently on the China slowdown in 2016, and also the European debt crisis. So we know from experience that some of these dislocations that we see in the market will be short term, and others, of course, will be longer term and will require a more analytical framework to work out the long-term implications. But that's what the team is working on day and night. So in terms of the structure of the presentation, first of all, I thought we'd give you a brief performance update, how the fund has fared in the first quarter of the year. Also talk a little bit about sort of the market backdrop with the COVID-19 and some of the macro indicators that we are seeing. But I think also more importantly, we'll look at some of the sort of key drivers of what we think are the important factors for equity markets, both on the short but also on the longer term horizon, and how we are positioning the fund for those potential drivers going forward. So if we start just as a recap on what SKAGEN Kon-Tikis is, it is our emerging markets fund. We are a highly active, value-based and unconstrained mandate. So the key hallmarks of the fund really over time have been, a very high active share. So we have maintained a sort of more than 90% active share throughout the fund's history, and that is no different. It is a concentrated portfolio of our best ideas, and that does mean that both our positioning and our performance will vary significantly from the benchmark over time. What really encapsulates our philosophy is what you see in the middle of the slide. Through time, you should expect the portfolio to exhibit real value characteristics. We have attempted as far as we can to update our forecasts in the recent weeks for what we see in front of us, and even with sort of pretty significant adjustments to our earnings expectations for both the next 12, 24 and longer term months. The portfolio continues to trade at very, very attractive multiples of earnings, and given the drawdown that we've had, the portfolio is now actually trading, some 20% below book value. And I think that's quite important to bear in mind that, that should provide us some form of downside protection should the market conditions persist that we see at the moment. Clearly, all markets have come down. So you see that the emerging markets index in green there, the middle bars, is also trading slightly below its long-term averages in terms of 11 times this year's earnings and just over current book value. And finally, in terms of the fund's characteristics, is a balanced market cap exposure. So on the right-hand side of the slide, you'll see that the portfolio is quite evenly balanced between large, mid, and small cap companies. During periods of stress, we sometimes see the small cap companies are sold off perhaps a little more heavily. The recent period has been no different, but it is an area of the market where we believe that an active manager can add significantly more value over time in terms of finding those future winners rather than those that have grown to be big index components based on historical performance. So we will continue to look in these emerging markets for domestic stories, often smaller companies that we believe can deliver long-term gains to our unit holders. If we look at put the setback into context, you know, the sad fact of the matter is that for most investors outside of the US, this drawdown has put us back pretty much 10 years. So in our euro asset class, you know, NAV has come back quite significantly. We do, since inception, remain comfortably ahead of the benchmark, but as I'll talk you through, the fund has had a challenging time, very much so over the last 3 to 5 years, where the value factor has been significantly underperforming more growth-oriented investment styles, and we'll touch on some of the reasons for that. If we look at the performance so far this year, in euro terms, the fund has returned negative 28%, which is about 4 percentage points below our EM benchmark, but it is a touch ahead of the value index that some of you compare us with. In the longer term perspective, you can see that our performance has not been as good as we would have liked in the last 5 or so years, and clearly one of the things that we're working on at the moment is to try and position the portfolio for what looks like a pretty different market backdrop to what we were expecting only a few months ago. If we look at what's been driving absolute performance this year, I think a number of funds will find it hard to find 5 positive contributors so far this year. In our portfolio, we have a couple of names that, despite the drawdown, have delivered decent returns so far. So as a contributor to the portfolio returns, our shipping company Euronav, which basically transports crude oil, has obviously been a big beneficiary of the big glut of oil, and we're seeing rates spike on the need to use these carriers as storage for surplus oil at the moment. Similarly, one of our longer term holdings, Samsung SDI, which is one of the leading electric vehicle battery manufacturers, has also continued to perform relatively well. It is protected in many ways by pretty good contracts with its customers, but obviously if we see the auto sector come under further pressure, there could be some risk to that. So we've actually reduced that position a little bit on the strength that we've seen this year. We also have a couple of newer positions in the portfolio, predominantly on the technology side, companies that we have been monitoring for some time and are also in some of the other SKAGEN portfolios. So Applied Materials and Micron Technology out of the US are some small positions that we have initiated more recently, and they've already made a positive contribution. On the negative side, the single biggest headwind that we've faced has been in the resources or commodity spectrum, where some of our winners from recent years, Ivanhoe Mines in particular, which is a African-focused copper and zinc miner, has had a pretty big correction on the back of lower commodity prices. Another winner for us last year, and the last 3 years actually, has been Atlantic Sapphire, which is land-based salmon farming based in the US, but for all intents and purposes, a Norwegian company with a very exciting technology, where again the currency headwind from the Norwegian listing has been a big drag on performance in euro terms. Two of our larger holdings in South Korea, Hyundai Motor and LG Electronics, they're both in the consumer discretionary space, have also been hit on expectation of lower demand going forward. But those impacts are largely driven by the size of the positions in the portfolio rather than a big drawdown relative to the rest of the market. If you look at the relative attribution, both by country and by sector, the biggest positive contributor so far this year has been our South African exposure, which is predominantly through Naspers, but we have also been adding back a pay TV operator in South Africa that we have owned in the past, and both of those two names have held up very well relative to the local index, which has boosted it. We've also had since the end of last year, fortuitously, we've had a relatively significant underweight in Brazil, which has given us a boost on the relative performance side, as Brazil has been one of the weaker markets year to date. And the Belgian exposure there is Euronav as its place of listing. We consider it to be a global company driven by global energy demand and the rates there. So that's more of a stock specific rather than a country allocation. If we look on the negative side, perhaps surprisingly for many, China has been the strongest equity market year to date. As some of you will know, we have a significant underweight to China and the fund. China is about 40% of the benchmark weight. We have 22% of the fund in China, which has given us a pretty significant headwind on a relative basis, unfortunately. However, in the last couple of days, we've seen some further weakness in some Chinese equities. So it's a situation that we are monitoring very, very closely indeed. Other negative contributors has been in India, where we have had an overweight in the fund, and we've been particularly hurt by our holding in State Bank of India, which is a state-owned bank, which looks to be part of the bailout of the financial system in India, which is coming at a cost, and therefore the shares have underperformed. If you look on the sector basis, I guess what sticks out there is that our energy exposure has actually helped us despite it being a weak sector. Again, that's where the Euronav holding comes in. We've also had a position in Royal Dutch Shell, which has outperformed many of its emerging market peers despite falling significantly in absolute terms, which has helped us on the relative side. Within financials, the clearest beneficiaries we've had has been our second largest position in the fund, which is Chinese insurance giant Ping An, and we've also had a relatively large position in Bank of China, both of which have held up very, very well, both compared with the Chinese market, but also compared with the sector overall. Although we don't have large investments in the internet names, we have had a number of IT sector investments. That's particularly our largest holding in Samsung Electronics, but also Samsung SDI, the battery manufacturer, which is classified there, which have given us a pretty significant boost on relative performance. This is also where our memory and tech hardware names, Micron and Applied Materials, have benefited us. On the negative side, predominantly it's been from what we don't own in terms of Alibaba, the Chinese internet giant. That has also held up well, which has given us a negative relative performance on that. And within consumer discretionary, our autos holdings, both in Hyundai Motor but also Mahindra and Mahindra in India, have hurt our performance. Unsurprisingly, given our exposure to the mining sector, which did very well for us last year. The reversal there on our copper names, particularly on Ivanhoe, is what has given us a relatively significant headwind on the materials side. If we then move on to sort of a quick recap, obviously this is the sort of frightening picture that most of us, I guess, check on, if not a daily basis. But this is the coronavirus page from the Johns Hopkins University. It is showing pretty clearly that what started as an isolated Chinese issue has very quickly become global, and the numbers are still increasing very rapidly in terms of confirmed cases, but also the number of deaths around the world. I think this shows one of the things that we are battling with at the moment. Whereas China did supposedly manage to get things under control within a 3-week span of cumulative cases having gone through 100. Similarly, in Korea, we saw that a number of Asian countries were able to get things under control, or seemingly under control, within a space of a few weeks. We have seen the problem shift from Europe and now increasingly to the US, which has the highest number of cases globally in terms of confirmed cases. Now, that means that what started as a sort of an emerging market kind of crisis has become a global crisis in terms of risk assets. We've seen a significant flight to safety with traditional safe havens such as gold, US treasuries and the US dollar have significantly underperformed traditional risk assets. There's not been a huge amount of differentiation within equities, most down sort of 20 to 25% in euro terms, but the clear outlier being the Chinese onshore equities, the China A shares, which are only down 8% year to date. We've also seen commodities and oil in particular being hurt by another exogenous factor, being the lack of an agreement within OPEC+, which has seen the oil price in euro terms fall by 65%. And that for those with interest in Norwegian equities is of course one of the main reasons why the Norwegian stock market has been a weak performer. If we look at the markets that mattered within Kon-Tiki, we can see the spread from -8% in onshore Chinese equities down to nearly -50% in Brazil. On the right-hand side of the chart, in terms of weaker countries, they have one thing in common, and that is resource dependency, particularly on oil, and that has translated into very weak currencies, which is the green part of the bar. So the numbers on the screen show the total return in euros, and the blue part of the bar is the local currency return, and then the remainder is through the FX. So whereas resource-intensive countries have seen their currencies weaken significantly, more safer havens currencies like the Swiss or the US dollar or the Japanese yen have held up relatively well. So these are all sort of traditional risk-off characteristics that we have seen in the recent months. Unsurprisingly then, perhaps in risk-off mode, then EM equities have underperformed developed market equities. So if we see year to date, emerging markets are down 24%, whereas developed markets are down 19%. This continues a trend which has been pretty much constant since the end of the financial crisis, with a couple of years where EM outperformed, but on the whole, developed market equities have favored better in this low interest, low growth world that we've seen since the financial crisis, and 2020 with the external shock that we've seen has been no different so far. One of the drivers behind sort of emerging markets higher volatility is that it is more sensitive to foreign investment flows. And what we've seen is predominantly in the bond market, but also in the equity market, we've seen very, very significant flows out of emerging markets at a multiple of what we saw both during the financial crisis and the taper tantrum of 2013. So you have a combination of fundamental factors working against you, but also you have money flows are exacerbating those problems. And it's exactly those kind of situations that we think can create very big dislocations between prices on the screen and the fair values that we think we can uncover. And that's why we think that the backdrop right now is conducive to active management. If we look also what is happening is, of course, governments are not asleep at the wheel. Both monetary levers are being pulled very hard, as they have been since the financial crisis, but we're also seeing fiscal firepower being deployed. So outside of wartime, the fiscal balance in the US is now the biggest deficit that we have seen. And we expect also the Chinese to continue to launch fiscal stimulus measures. And we've seen a number of measures in the European Union and Japan as well. And without wanting to show any detail behind it, I mean, this is on a country list compiled by Bank of America, Merrill Lynch. But basically on the monetary side, what we've seen is pretty much pretty stable, sort of 50 to 150 basis point rate cuts across the board. A number of countries highlighted there in the middle of the chart. And then we've seen sort of fiscal stimulus announcement pretty much in the greater than 3% range. It is, of course, not enough to offset the headwinds that we are seeing at the moment. Many of those are government mandated, but it is clear that governments around the world are taking this very, very seriously and will be throwing a lot of resources at it in order to kickstart economies again as we come out of the coronavirus times, hopefully. If we look to sort of some of the macro data points, many of us are looking towards China as a sort of, can they be a canary in the coal mine or a guiding light as to what might happen? I always treat official data coming out of China with a pinch of salt, but certainly when you look at sort of diffusion indices or other indicators, it looks like that in many cases the country is sort of resuming towards 70–80% of prior levels. This is one by HSBC research, where basically the work resumption barometer is running roughly at 80% of what it has done after previous Chinese New Year celebrations. So things are slowly coming back to normal, and any data point like this that we can see out of China is obviously what market participants are hoping will play out also in other countries around the world. If we look at sort of harder data, both daily coal consumption is trending back towards normal. I have also spoken to a number of contacts within China, both in smaller enterprise, but also on the research side, and the feedback is relatively conducive to this data, that sort of slowly but surely one is resuming a level of activity which is sort of between the 50–80% range of what others have seen historically. Of course, there will be big sector differences. So we saw out of Shanghai again that cinemas were closed again. Restaurant trade is obviously still being curtailed quite significantly, but other parts of the economy are already at or very close to historical levels. So even IT sort of auto dealerships that we have spoken to are back to sort of being fully open, and activity levels are returning. So that is encouraging if it is sustainable. How do investors look at this at the moment? Well, One of the indicators that we follow is the Bank of America Merrill Lynch Investor Sentiment Index. It basically hit rock bottom as of last week. As you can see on the right-hand side of that, investors are volatile by nature in terms of sentiment, but these extreme readings are something that we have also seen historically, and the reversal can happen pretty quickly. If we look back to the last time where we had a prolonged period of weak investor sentiment was back in 2008-9, where the readings stayed down there for nearly a year. And even though the investor sentiment reached zero in the summer of 2008, it took another 5 to 6 months before the market fully bottomed. So while we don't want to speculate in terms of short-term market movements, it is clear that one of the sort of precursors for the market's bottoming out is also investor sentiment bottoming out first, and we are certainly pretty close to investor sentiment being very, very weak indeed. In terms of valuations, when you look at price to earnings multiples, which is what this chart does, in blue you have the developed market index, and in green you have the emerging markets index. I would take these with a pinch of salt, because basically this is based on forward-looking consensus estimates, and I think most analysts in the analyst community are both too slow and too uncertain to cut their earnings estimates sufficiently. So whilst this looks like a big drop in terms of the PE multiple of the market, I do think that we have much further downside on the earnings numbers, and therefore the multiples look artificially low. What I look at instead is looking at global enterprise value to sales, for example, on a trailing 12-month basis. You've also had a significant correction here in EV sales levels, but as you can see, we are still some way off the sort of trough levels that we have seen in the past. Sales will also, of course, fall, but they tend not to fall as much as earnings, and therefore I think this is a more accurate representation of the valuation kind of setback that we have seen in the market. And certainly in emerging markets, we are getting closer to levels at which we have found support historically. But if you look at if you're really looking for trough levels, then we are still some way off there, and the correction may have further to run. If you look at then one of the key things I would say in terms of outlook and how we are thinking about positioning is that I think the belief that the markets can decouple from the economy for long periods of time, I think will be severely put to the test. We had already seen that valuation multiples had risen quite significantly during the course of 2019, which was of course a very strong year for equity markets. It's always easier in hindsight to say that valuations were high and therefore we would do a correction. Valuation alone is not a reason to have a correction, and I think the coronavirus has been a catalyst, but the main reason why we have weakness in the markets is because there is a real change in the fundamentals of the economy, certainly in the near term and potentially longer term as well. So I think this is a chance to really get back to focusing on fundamentals and make sure that the margin of safety of what one is buying or what one is holding is really there and not just an illusion. It's also that the market is volatile. We have a lot of uncertainty. Last Thursday, the Dow Jones Industrial Average actually found itself at the same time in a technical bear market and in a technical bull market. The Dow Jones Industrial Average had fallen more than 20% from peak, but it had also risen more than 20% from its recent trough. And that just shows again the sort of volatility and the uncertainty in the market, that in the short term it's very, very difficult to make any kind of clear predictions, which is why we focus on the longer term fundamentals and things that we can actually try and measure and assess from a real valuation perspective. Whilst activity levels in the portfolio are higher than normal, we're not trying to second guess sort of day-to-day market movements given the volatility that we have. Also, with respect to history, within sort of longer structural bear markets, there are always periods of very decent short-term returns. So the sort of bounce that we had last week and then a further fall again today, it's really quite usual in these kind of market situations where you have both fundamental changes, but also you have a lot of money flows and technical selling pressures depending on how things shake out. So we would expect to see further volatility before sort of one big sort of direction asserts itself. If we look at sort of longer term history, in many ways, the correction on earnings multiples that we've had so far in the US market has been similar to history. The one thing, as I cautioned earlier, is that we haven't seen the big cut to earnings estimates yet. So I think purely from a sell-off perspective, we have gone through a lot of pain. The bear market that we registered is the quickest on record, but we do see some need for earnings expectations to be corrected as well. I mentioned earlier in terms of stimulus, certainly over the last 10 years, Fed balance sheet has been a very big, powerful driver of risk appetite and market drivers, and clearly with the combined measures that we've seen, there is a lot of liquidity, a lot of support for markets at the moment. So I think that is one of the sort of the positive drivers at the moment, certainly. For the US market. However, one thing that we do sort of keep an eye on is that starting the money presses is a risky change of action. We have seen the Venezuela stock market is a very big difference in terms of its local currency returns and US dollar returns. If you look at the last 5 years, the hyperinflation of Venezuela has basically ruined any kind of foreign currency returns in that market, whereas local currency returns, of course, have been a very, very different matter. The reason why I bring this up is not because we think that the world is entering a hyperinflationary stage. It's just a case of deflation is a risk that is very often thrown around. That means that governments around the world feel no pressure in terms of their ability to use unconventional measures to support the economy and to support the markets. And it's certainly one thing that we bear at the back of our mind is that if these kind of measures become stay for too long, that will add a different kind of risk that the market is currently not pricing at all. So with those kind of opposing forces at play, how do we think about the portfolio and our positioning? Well, firstly, we think that the stimulus packages, both the monetary and the fiscal side, will drive dislocations in markets. Traditionally, the monetary policy that we've seen since the financial crisis has very clearly favored growth stocks and developed market equities, where basically the willingness to look far in the future for returns has been expanded. We have seen historically in other market cycles that big fiscal stimulus has tended to favor more value stocks and also more resource intensive countries and risk assets over time, and certainly it's not something that we would rule out, that if activity levels suddenly accelerate from a deep trough, that these types of overlooked assets could again look attractive. That's definitely something that we think is a possibility. So we therefore try and do a barbell approach to the portfolio. Of course, we're very focused on protecting the now. It means that we have a number of more defensive consumer type names into the portfolio. We have technology enablers, often developed market companies that sell into supply chains, etc., in emerging markets or into China in particular. And it's an opportunity for us to pick up higher quality companies at sold down prices at the moment. When we talk about holding company discounts and discounts to observed value today, we also see that often conglomerates, etc., are the more liquid parts of the market, and we therefore see that their discount to net asset value expands as foreign investors have to sell what is more liquid, and that has given us an opportunity to buy back former holding companies that we have owned before. We also focus a lot of our time on balance sheet. In aggregate, our portfolio has a net cash balance, largely because of our big holdings in South Korean companies, which tend to have very, very strong balance sheets and low payout ratios. And also, as I will show in the next couple of slides, is that we do think that the current dislocation between value sectors often offering inflation protection has now become very, very attractively valued in a historical perspective. I think also to bear in mind, we try never to be caught up in the current market psyche. It's always a guiding principle to remember that it's never as good as it looks, and it's never as bad as it seems. The stock market has a tendency to self-correct whenever it has been thrown too far in one direction or the other. So I think I will leave with a couple of slides before I go into the portfolio. But I think it's worth remembering that even though EM returns have been disappointing in recent years, it is a global phenomenon outside of the US. In US dollar terms, both EM and global equities ex-US have delivered relatively lackluster returns over the last 12 years. We have seen, despite the sell down in the US, another run to safety in US dollar type assets, and we think that is one of the dislocations in the market that has happened over time. A lot of the support in US companies has driven by financial engineering and using balance sheets to deliver earnings growth. And we think that in many ways that kind of activity will be much harder now in a tougher economic backdrop. When it comes to emerging markets going forward, in the green line here you have the US dollar index, and in the blue line you have EM equities relative to developed market equities. So directionally it is very much a play on the US dollar. A stronger US dollar tends to favor developed market equities over emerging markets. We don't forecast currencies and we don't hedge in the fund, but it is notable to see that the economic backdrop that we've had over the last 10 years has very much favored US dollar type assets, monetary policy driven. And in the period prior to that, where we had more resource intensive growth, we had the ascension of China on a relative basis, the US dollar was weaker, and emerging market assets did outperform for a very significant proportion of time. I mentioned the dislocation between value and growth. Here you have the EM index split into value in blue and growth in green. This is the forward 12-month price to earnings multiple, and whilst you've had a correction in growth assets, they are still trading materially above levels they were outside of the last 3 years, whereas value type assets, so more commodity heavy, more financials, they are now trading at multiples that we have not seen since the depths of the financial crisis. Now, as I mentioned, we expect earnings to be cut, so the multiple is artificially depressed, but that was also the same issue that one had in the financial crisis. So in terms of the relative earnings correction to come, I don't think it's necessarily much greater than it was in 2008-9. So I think the numbers are still comparable in a historical perspective. So in terms of portfolio positioning, I said that we have some commodities type exposure as a relatively cheap insurance policy. I talked about holding companies where we have strong balance sheets and liquid holdings within those companies, and we get the diversification. On top of that, we also have a number of technology enabler names, Samsung being the biggest one, but also in industrial automation and in 5G networks. A big proportion of the portfolio is in financial services. It is not traditional banking. It is predominantly in insurance and in reinsurance, but we do have about 13% of the portfolio in banks, where we feel that both the macro backdrop but also the company-specific drivers are strong enough to warrant recovery from current low valuation. We have quite diversified consumer exposure, both in consumer discretionary, in our Korean holdings, and we have a number of consumer staple companies across Africa and Russia and in Brazil, which we believe offer long-term growth opportunities as well. So this is the top 12 holdings in the portfolio. We have actually been through all of these top 12 holdings, adjusted our earnings estimates for 2020 and beyond. So the valuation snapshot you see here is an appropriate one. So you can see that our top 12 holdings are trading on approximately 8 times this year's earnings and a close to 30% discount to the last reported price to book value. One of the things that has changed over the last 12 months in the portfolio is that the running yield of the portfolio is now very attractive in my view at 4%. A number of these companies have already committed to paying the dividends for 2019, so it's being paid now in 2020, and we think that offers a pretty attractive characteristic to the portfolio on top of the low earnings and book value multiples. In terms of positioning, there aren't any huge sort of dislocations other than what I talked about earlier. Our two biggest countries are South Korea and China, both 22% of the portfolio. One becomes a large overweight and the other one becomes a large underweight purely because of the different sizes in the index. But I think it's very important to highlight that most of our South Korean holdings are global companies. They're not domestically focused, which I think is important given the challenges in the South Korean economy. Other large overweights in terms of countries are in Russia, where it is predominantly driven by financial services and consumer. We have no exposure to the energy sector in Russia. And then outside of the benchmark countries, we maintain a roughly 7% exposure to frontier markets, where Vietnam is our biggest one. And then outside of emerging markets, we have a number of our energy related holdings and commodities in DM countries like Netherlands for oil, Dutch Shell, and Euronav in Belgium, rather than through companies listed in emerging markets per se. But the economic exposure is very much towards emerging markets. So I think I have rambled off enough. I can see from the chat that there are already questions coming through, so I will hand the word over to Ole Christian so that he can chaperone me through that. But thank you very much for your attention.
Thank you very much indeed, Fredrik. Like you said, there are 2 questions on the chat already, and I'll read you the first one. We've seen record outflows in emerging markets and worldwide in equity and bond markets. How do you view the relative recovery scenario for emerging markets? In other words, will emerging markets recover faster than developed markets like the US?
I will almost back out of that question because, as I said earlier in the presentation, we try not to make a short-term call on the market. I think in the same way that our other funds do, we try and find companies that can weather different types of market environments. Of course, there will be times where we make changes depending on the backdrop that we see and the prices on offer. But ultimately, we are trying to build a robust portfolio for several different market environments. What I would say in terms of looking at investment flows as a precursor or predictor of relative performance, I think it's more of a lagging indicator. So what we see historically is that when emerging markets do well, they attract inflows. And when there is a risk-off environment or they do less well, then we do get money being pulled out. It's one of the characteristics of emerging markets that you do have pro-cyclical flows, and they can, in the short term, alter fundamentals. But over the longer term, we think that the prices of the companies we invest in follow the actual fundamentals rather than the relative flows.
Okay, thank you very much. And another question is, would you like to elaborate a bit on the developed market holdings like RD and Micron? Why are those in emerging market portfolio?
Yeah, so I can talk firstly from a strategic perspective and then on the 2 companies in particular. From a strategic perspective, we always look for the economic exposure of the companies that we invest in. And what is absolutely critical for the fund is that it offers emerging markets exposure in terms of the economic drivers of the companies. Often we find that kind of economic exposure is differently priced in different markets. So one of the things that we use within the unconstrained mandate is to look for the best risk reward for any given type of situation that we're looking at, and place of listing can be a source of sort of potential alpha from that, because investors who have more constrained mandates will have to follow it more rules driven. When it comes to Royal Dutch Shell and Micron, which are 2 of the larger developed market listings in the fund, Royal Dutch Shell is in the portfolio as a global energy investment. It has close to 2/3 of its upstream portfolio in countries that are characterized as emerging markets, and the biggest delta in terms of demand for its products is energy intensity in emerging markets. Also, we find that the corporate governance and the shareholder treatment at Royal Dutch Shell seems superior to us than many equivalent companies or similar companies in emerging markets, where typically governments are the majority shareholder. So we simply feel more comfortable with Royal Dutch Shell from an energy transition perspective, from a corporate governance perspective, and we get what I would deem to be a superior economic exposure on top of it. On Micron, it's a memory manufacturer. We've invested in Micron after having been invested in Samsung, its biggest competitors, for years and years and years. We like the memory space. Most of the memory sales go into the supply chain in Asia and China in particular. So again, as an economic exposure, it's largely an Asian business, and then sells onwards. Its customer sells onwards globally. So it's a global market where the risk-reward position is very, very attractive, and we know the industry from Samsung as well.